All right, let's just be honest for a second. Those words, tax season, they can make anyone, even a really experienced business owner, just, you know, feel a bit stressed.
Oh, definitely. It feels like this mountain of paperwork, right? And this dense IRS language.
Yeah, exactly. You're wondering, am I missing something? Am I leaving money on the table?
It's a very common feeling. The sheer amount of information is, well, that's a lot.
And that is exactly why we're doing this deep dive. We've taken IRS Publication 334, that's the official guide for small businesses, the one you need for your 2024 returns, and we've really tried to pull out the most critical stuff.
Right. Cutting through the jargon.
Our mission is basically to give you a shortcut, help you get informed, file accurately, and, maybe more importantly, find those key tax-saving opportunities.
Those moments that can really make a difference to your bottom line.
Exactly. We're looking for those aha moments. So let's get into it.
Yeah.
Are you self-employed? The foundation of your tax journey. Okay, first things first. How do you even know if the IRS considers you self-employed? Seems obvious, but maybe it's not always.
Well, fundamentally, you're self-employed if you're running a trade or business as a sole proprietor or an independent contractor.
Okay.
And here's something that catches people out. It doesn't have to be a full-time thing. Even a side hustle, gig work, if you're doing it intending to make a profit, that counts.
So my weekend craft fairs, or maybe some freelance work I do occasionally,
Yeah,
even if it's not a huge amount of money, that could put me in this category.
absolutely. If the intent is profit, then yes, that's a really key distinction.
And what about the different business structures, like how they look from a tax angle?
Right. So a sole proprietor is just an individual who owns an unincorporated business themselves. Simple as that. And this also includes most single-member LLCs, unless you've specifically elected to be taxed differently.
And they use Schedule C, right?
That's the one, Schedule C. Then you have independent contractors. Think consultants, designers, plumbers maybe, who offer services to the public.
Where the client controls the result, but not how you do the work.
Exactly. The how is up to you and their earnings, subject to self-employment tax.
Okay. Now, I've heard about something called statutory employees. It sounds a bit in between. What's that about?
Ah, good question. It's a unique category. A statutory employee actually gets a Form W-2, like a regular employee.
Okay.
But Box 13 on that W-2 will be checked. And even though it's a W-2, they report their wages and, crucially, their business expenses on Schedule C.
So they could deduct business expenses that maybe a typical W-2 employee couldn't.
That's the main advantage, yes. It gives
Yeah.
them more flexibility for deductions related to that specific work.
Got it. Now, a big one for couples running a business together. How should they handle that for taxes? Are there common mistakes or maybe simpler ways?
Okay, this is where we find a really great aha moment, especially for married couples.
Ooh.
So traditionally, if you and your spouse own and run an unincorporated business together, sharing profits and losses, you're generally treated as a partnership.
Which means filing a partnership return, Form 1065.
Yeah.
That sounds complex.
It can be, yeah. More paperwork, potentially higher prep fees, but
Yeah.
there's an exception called the qualified joint venture, or QJV.
QJV. Yeah.
If it's just you and your spouse, you jointly own and operate the business, and you both materially participate, you can elect not to be treated as a partnership.
So what's the payoff there? Avoiding that 1065 sounds like a win already.
It's a huge simplification. Instead of that partnership return, each spouse just files their own separate Schedule C and, importantly, their own separate Schedule SE for self-employment tax.
Ah, so you each get credit for Social Security earnings individually.
Exactly. That's crucial for building your future benefits. You get the simplicity and the individual Social Security credits. It's really the best of both worlds for many couples. Just a quick note, this usually applies if you haven't formed like a state law LLC.
That is a super valuable tip. Okay, before we jump into the filing mechanics quickly, ID numbers, SSN, ITN, EIN. When do you need which?
Pretty straightforward. Your Social Security number, SSN, is your main ID for individual taxes. An ITAN, or Individual Taxpayer Identification Number, is for folks who need a tax ID but aren't eligible for an SSN, like certain resident or non-resident aliens.
Okay.
And the EIN, Employer Identification Number. You generally need that if you have employees or if you file certain other tax returns, like for pension plans or excise taxes. It's just about using the right number for the right task. 2, filing your business taxes. The how-to.
Okay, so you figured out you're self-employed. Now the nitty-gritty, actually filing. What are the core forms we're talking about?
Your main income tax return is Form 1040 or 1040 SR. Attached to that, the key form is Schedule C, profit or loss from business.
And you need a separate one for each distinct business, right?
That's right. If you're a designer and you run an Etsy shop, say that's 2 Schedule Cs.
Okay, and Schedule SE.
Schedule SE, self-employment tax. You file that if your net self-employment earnings hit $400 or more. That's the threshold. It also gets filed with your 1040.
$400, got it. Now, IRS e-file. Everyone talks about it. Is it really the best way?
Oh, absolutely. I mean, the advantages are pretty clear. Faster processing, generally more accurate returns because the software catches errors.
And faster refunds, which is always nice.
Definitely. Most e-filed refunds arrive in less than 21 days, especially with direct deposit. Plus, you get that confirmation receipt almost immediately. Peace of mind.
And signing it electronically is easy.
Yeah, the self-select PI method makes it totally paperless. Super simple.
Okay, but what if the opposite happens? What if you owe money? How do you pay?
The IRS has made that pretty flexible, too. Electronic funds withdrawal from your bank, credit, or debit card. You can even pay with cash at certain retail partners now.
Right. But here's a crucial bit. Extensions. You can get an extension to file. Form 4868 gives you 6 more months.
Correct. An automatic 6-month extension to file the paperwork.
But not to pay. Right. This trips people up.
Exactly. And this is so important. Why is knowing that distinction absolutely critical?
Because you still owe the money by the original deadline. April 15th for most people.
Precisely. If you get an extension to file but don't pay an estimate of what you owe by April 15th, 2025 for the 2024 tax year, you could face penalties and interest.
Ouch.
Wow.
So even with an extension, you have to estimate and pay by the deadline.
Yes. Estimate as best you can, pay that amount. It avoids unnecessary extra costs down the line.
Good advice. And if someone needs help, maybe can't afford a tax pro, are there free resources?
Yes, loads of them. IRS.gov is the starting point forms, publications, tools. But also check out IRS Free File if your income is $84,000 or less.
84,000. Okay.
And there's VITA, Volunteer Income Tax Assistance for low to moderate income folks, and TCE, Tax Counseling for the elderly, for those 60 and over. Great free options. 3, the accounting framework, periods and methods.
All right. Let's shift to the backbone of your records, your tax year and your counting method. Most individuals use the calendar year, Jan 1 to get 31. Same for small businesses.
Generally, yes. Most sole proprietors will use the calendar year. It just keeps things consistent for tracking income and expenses over that 12-month period.
Okay. And then the methods. Cash versus accrual. This feels like a big decision. How do they work?
It is a significant choice, and it impacts your cash flow. The cash method is usually simpler. You report income when you actually get it or when it's constructively received.
Constructively received. What does that mean exactly?
It means the money is available to you without restriction. Think interest credited to your bank account. Even if you haven't withdrawn it, it's available.
So you can't just, tell a client not to pay you until January to avoid the income this year?
No, not if the money was technically available to you earlier. If it's constructively received, it's income. And for expenses on the cash method, you deduct them when you actually pay them.
Okay. So if a client mails a check late December, but I don't get it till early January, using the cash method, that's next year's income.
Correct. It's about when you actually have access to it. Now, the accrual method, that's different.
Right. Income when earned, expenses when incurred.
Exactly. You report income when you earn it, regardless of when you get paid. So if you finish a job or sell something in December 2024, even if payment comes in February 2025, that's 2024 income under accrual.
And expenses are deducted when you incur the liability, not necessarily when you pay.
Right, when the all events test is met and economic performance has occurred.
What's interesting you mentioned is maybe using different methods for different things, like business versus personal, or even for separate businesses.
Yeah, that is possible sometimes, provided you keep completely separate and accurate books for each. But what about businesses selling physical goods? Inventory. Doesn't that usually force you onto the accrual method?
That's what I always thought. Inventory seems complex.
It usually does, yes. If inventory is a significant income-producing factor, accrual method and tracking inventory are generally required. But here comes a massive aha moment for many smaller businesses.
Okay, I'm ready.
The small business taxpayer exception. This is huge. If your average annual gross receipts are $30 million or less.
$30 million. That covers a lot of small businesses.
Right. And you're not a tax shelter, you can actually choose not to keep inventory in the traditional sense for tax purposes.
Really? You don't have to track inventory values.
You can choose to treat those items as non-incidental materials and supplies, basically, deduct them when you use or consume them, or you can just follow whatever method you use for your financial accounting.
Wow, that sounds like a massive simplification. Less bookkeeping, less hassle. That's a direct saving right there, just in time and effort.
It absolutely is. And it ties into another simplifying rule, the Uniform Capitalization Rules, or UNICAP.
UNICAP.
These generally make you capitalize certain direct and indirect costs into the cost of goods you produce or buy for resale, meaning you deduct them slowly over time.
More complexity.
Yes. But again, that same small business taxpayer exception, the $30 million threshold, generally exempts you from UNICAP as well.
So double simplification. You potentially avoid complex inventory in UNICAP. That could mean deducting more costs up front, right? Lowering immediate taxable income.
Spot on. It makes things much easier and can definitely improve your immediate cash flow by allowing quicker deductions. Just remember, if you want to change your overall accounting method, you generally need IRS approval using Form 314V. Your business income, what to include, what to exclude.
Okay, we've got the structure, the accounting methods. Now, income. Rule 1 seems to be report everything connected to the business, right? Even if you don't get a 1099.
Correct. Your tax return needs the full picture. Sales, services, sure, but also non-employee compensation from a 1099 NEC, maybe NIL income.
NIL. Name, image, likeness.
Yeah, that's becoming more common. Also, payments via cards or third-party networks, like on Form 1099K. Though, be careful with the 1099K, the reported amount might need adjustment to match your actual income.
Right. Now, here's a fascinating one you mentioned. Bartering. If I trade my services for, say, some graphic design work, or maybe a lawyer gets paid in stock, is that taxable income? No cash involved.
Yes, absolutely. The fair market value of whatever property or service you receive in that barter exchange is income.
Fair market value, so what it's worth.
Exactly. If you agree on the value beforehand, that's usually considered the fair market value. So yeah, the lawyer getting stock, or maybe an artist paying their rent with a painting, that's reportable income equal to the value received. Even those credits you get in a barter exchange club count when they hit your account.
No escaping that one. Okay, but what about canceled debt? Is that always income? Because owing tax on debt forgiveness sounds rough.
It usually is income, yes, that's the general rule. But here's a really important aha moment. A direct tax saver, especially if times are tough. There are major exceptions.
Okay, good. What are they?
Debt canceled in a Title XI bankruptcy case, not income. Debt canceled when you are insolvent, meaning your debts are more than the fair market value of your assets. Also, generally not income.
That's a huge relief. Do you need a special form?
Yes, you usually file Form 982 to claim these exclusions. It's crucial protection.
Definitely. Any others?
Yes, and this is big for real estate businesses. You can elect to exclude canceled qualified real property business debt.
Okay. What qualifies?
It's debt taken on to acquire, build, or substantially improve real property used in your business, and it has to be secured by that property. If debt like that is canceled, you can potentially exclude it from income.
How does that work? You just don't report it.
You elect the exclusion, usually on Form 982, and then you generally have to reduce the tax basis of your depreciable real property by the amount you excluded. So it might affect future depreciation or gain loss on sale, but it avoids the immediate income hit. It's a major potential saver.
So even bad news like debt cancellation can have silver linings tax-wise. What about things that are definitely not income?
Well, just property appreciating in value isn't income until you sell it. If you hold goods on consignment for someone else, that's not your income until they sell.
Okay.
Certain Medicaid waiver payments are often excluded. A bona fide loan you receive isn't income because you have to pay it back.
Makes sense.
And sales tax. If you collect sales tax from customers that you have to send to the state or local government, that's not your income. It just passes through you. Business expenses. The heart of your tax savings.
All right, the main event for many folks, deductions. How do we keep more of that hard-earned cash? What's the absolute golden rule for deducting a business expense?
The golden rule is simple. It must be both ordinary and necessary.
Ordinary and necessary. Okay, break that down.
Ordinary means it's common and accepted in your specific trade or business. You know, something peers in your field would typically spend money on.
Right. And necessary. Does it have to be essential?
Not necessarily indispensable, but helpful and appropriate for your business. It should help you run your business or make a profit. And crucially, no personal expenses allowed.
What if something is mixed use, like a phone or car?
You must allocate. Keep good records to show the business versus personal usage and only deduct the business portion. Record keeping is absolutely vital here for maximizing your savings.
Okay, let's hit a big category. Car and truck expenses. You've got two main choices, right? Mileage or actual costs.
That's right, and picking the right one can save you real money. You can use the standard mileage rate for 2024, that's 67 cents per business mile,
67 cents, okay.
or you can track and deduct your actual expenses.
Which includes?
Gas, oil repairs, maintenance, tires, insurance, registration fees, and depreciation if you own the car, or the business part of your lease payments if you lease.
So how do you choose? What's the best strategy?
My best advice. Always figure it out both ways, especially if you own the car. See which method gives you the bigger deduction for that year.
You can switch back and forth if you own.
Often, yes. But if you lease and start with the standard mileage rate, you're usually stuck with that for the whole lease term. So choose carefully there.
Good tip. Are there situations where you can't use the standard mileage rate?
Yes, a few important ones. If you operate a fleet, like 5 or more cars at once, or if you've already claimed certain types of accelerated depreciation, like Section 179, on that same car in a prior year, always check the rules.
And commuting. That's still a no-go for deductions, right? Driving from home to your main office?
Correct. That's generally considered personal commuting, not deductible. But driving from your office to a client site or to a temporary work location, that is deductible business travel.
Yeah, what about a home office? If that's your main place of business.
Good point. If your home office qualifies as your principal place of business, then driving from your home office to other business locations is deductible. That's a key exception.
Okay, that leads nicely into depreciation, spreading the cost of big assets over time. But you mentioned Section 179, taking the deduction now. That sounds way better for cash flow.
Oh, it absolutely is. Section 179 is a fantastic tax-saving tool. It lets you elect to deduct or expense a significant portion or even all of the cost of certain qualifying property in the year you put it into service.
Instead of slowly depreciating it.
Exactly. For 2024, the limit is quite high, generally $1,220,000. So for most equipment purchases a small business makes, you might be able to write off the entire cost immediately.
Wow, that's a huge potential deduction up front. Are there limits on things like vehicles?
Yes, there are specific lower limits for certain vehicles, especially heavier SUVs. For 2024, the Section 179 limit for many SUVs is $30,500. So you need to check the specifics for vehicles.
Still a very powerful tool. Any catches?
The main one is recapture. If you claim Section 179 and then later your business use of that property drops below 50%, you might have to pay back or recapture some of the deduction you took.
Okay, something to keep in mind. Now, paying employees,
Yeah,
wages,
sure.
bonuses, benefits, these are deductible, but any hidden savings.
Well, the costs themselves, reasonable wages, bonuses, health plan contributions, education assistance, are deductible business expenses. But here's a neat aha moment. Some fringe benefits can be set up, so they are deductible for you, the employer, but excluded from the employee's taxable income.
Like a win-win.
Exactly. Things like certain health benefits, maybe some education assistance, it's a deduction for the business, and tax-free income for the employee. Great for attracting talent.
Smart. What about insurance? Business insurance premiums.
Generally deductible. Fire, theft, liability, workers' comp, malpractice, business vehicle insurance, all typically deductible.
What's not deductible?
Things like setting aside your own reserves for self-insurance usually aren't, or life insurance policies where the business is the beneficiary. But a huge one for sole proprietors and partners is the self-employed health insurance deduction.
Right. Deducting premiums for your own health insurance.
Yes, potentially medical, dental, and qualified long-term care insurance premiums for yourself, your spouse, and dependents. It's an above-the-line deduction on your Form 1040, which is really valuable.
Okay, good one. Interest on business loans.
Deductible, as long as the loan proceeds were actually used for business purposes. If it's a mixed-use loan, allocate the interest carefully.
And fees for accountants or lawyers.
If they're ordinary and necessary and directly related to your business, deductible. This includes the business portion of your tax prep fees, too.
Pension plans.
Yeah.
Deducting contributions for retirement.
Absolutely. Contributions you make for your employees to plans like SEPs, Simples, or qualified plans are deductible on your Schedule C. And contributions you make for yourself to these plans are deductible on Schedule 1 of your 1040.
Powerful way to save for retirement and get a tax break now.
Very powerful. Plus, there might even be tax credits available for the startup costs of setting up a new plan. Extra savings.
Rent expense seems simple. Pay rent for your office, deduct it.
Mostly, yes. Rent for property you use in your business is deductible. The main catch is if the payments give you equity or title in the property, like a lease-to-own situation, then it might be treated differently. Also, you can only deduct rent for the period it applies to within the tax year, even if you prepay.
Okay. And what about taxes themselves? Can you deduct taxes you pay as a business?
Many of them.
Okay.
Yes. State or local income taxes on the business profits, the employer's share of Social Security and Medicare taxes for employees, federal unemployment tax, FETA, personal property taxes on business assets, real estate taxes on business property, excise taxes, all generally deductible.
What's not deductible?
Your federal income tax itself is never a business deduction, and sales taxes you collect from customers are just passed through.
But what about the self-employment tax we pay on our own earnings? Any deduction there?
Yes, and this is critical. You get to deduct 1/2 of your total self-employment tax paid. It's an adjustment to income on Schedule 1 of Form 1040.
So that directly lowers your adjusted gross income. That's a big saver.
It really is. Don't miss that one.
Travel and meals. If you travel for business.
Deductible if you're away from home, which generally means your trip is long enough to require sleep or rest. Costs like airfare, hotels, transportation are deductible.
And meals while traveling or with clients.
Business meals have that 50% deduction limit, so you can generally only deduct half the cost, provided the meal has a clear business purpose.
Okay, 50%. Now, the business use of your home. This one feels tricky. Lots of rules.
Very strict rules. The IRS watches this one closely. To qualify, you need exclusive and regular use of a specific area of your home.
Exclusive means only for business.
Yes. If you use the space for personal activities too, like a family den that doubles as an office, it generally won't qualify. It also has to be your principal place of business, or a place where you regularly meet clients, or perhaps a separate structure not attached to your house.
So the kitchen table probably doesn't cut it. Calculating the actual expenses portion of utilities, insurance, depreciation sounds complicated.
It can be, which is why the simplified method is such a great aha moment for many.
The simplified option. How does that work?
Super straightforward. Instead of tracking all those allocated actual expenses, you can just deduct $5 per square foot of your qualifying home office space up to a maximum of 300 square feet.
So a maximum deduction of $1,500 per year. 5 by $300 SKU reps.
Exactly. Much simpler record keeping. It can be a huge time saver, and for smaller spaces, it might even give you a better deduction than calculating actuals.
That simplicity is definitely a win. Okay, another potential immediate saver. The de minimis safe harbor for tangible property. Sounds technical, but what's the benefit?
This is another excellent aha for saving time and potentially getting deductions faster. It lets you immediately deduct the cost of lower-priced tangible property items instead of having to capitalize and depreciate them over several years.
Like what kind of items? Laptops? Tools?
Exactly. Laptops, printers, tools, office furniture, small equipment. If you don't have what's called an applicable financial statement, which most small businesses don't think formal audited financials.
Right, most of us don't have those.
Then you can elect to immediately deduct items that cost $2,500 or less per item or per invoice.
$2,500 per item. That covers a lot of routine purchases. How do you claim it?
You just make the election annually by including these costs under other expenses on your Schedule C. It simplifies bookkeeping immensely and accelerates your deductions. It's a fantastic tool.
That really helps avoid tracking lots of small assets over years. Great tip. Any other common deductible expenses, and maybe a quick list of things you absolutely cannot deduct?
Sure, other common ones include advertising, bank fees on your business accounts, office supplies, business-related utilities. Things you generally cannot deduct include personal living expenses, entertainment costs, those are mostly gone now, lobbying, political contributions, and fines or penalties paid to a government. 6. Figuring your net profit or loss.
Okay, so you've gathered all your income, subtracted all those allowable deductions we just talked about. What's the result?
Simple math, really. Gross profit minus your total business expenses equals your net profit or loss for the business.
And if expenses are actually more than income, you have a loss. Is that always a bad thing? I heard about net operating losses, or NOLs.
Right. If your deductions exceed your income, you might have a net operating loss, NOL. And no, it's not necessarily all bad news from a tax perspective.
How so? Can it save you taxes later?
Yes, potentially. An NOL generated from your business can often be carried forward to future years to offset taxable income in those years.
So a loss this year could reduce your taxes next year or the year after.
Exactly. It helps smooth out the tax impact of business ups and downs. There are rules and limitations, of course, but it's a valuable provision. Just be sure your activity is genuinely carried on for profit, not just a hobby, as hobby loss rules are much stricter. 7. Self-employment, SE tax. Understanding the Social Security contribution.
Last big topic, self-employment tax. This is basically how we, as self-employed folks, pay into Social Security and Medicare, right?
Correct. It ensures you're building credits for future retirement, disability, and survivor benefits, just like employees do through payroll taxes.
Who has to pay it?
You generally have to pay SE tax if your net earnings from self-employment are $400 or more. Remember that threshold.
$400 again. And the rate.
For 2024, the rate is 15.3% on your net earnings. That breaks down to 12.4% for Social Security, but only up to an annual income limit, $168,600 for 2024, plus 2.9% for Medicare, which applies to all your net self-employment earnings.
15.3%. That's hefty. But didn't we mention a deduction related to this?
Yes, absolute crucial tax saver here. You get to deduct 1/2 of your calculated self-employment tax.
Where does that deduction go?
It's an adjustment to income on Schedule 1 of your Form 1040. It directly lowers your adjusted gross income, or AGI, which can reduce your overall income tax. Huge benefit.
Okay, good reminder. Now here's something that sounds really weird. Optional methods for calculating SE tax. You mentioned sometimes people choose to pay more SE tax than their profit would normally require. Why would anyone do that?
It does sound counterintuitive, doesn't it? Pay more tax. But there's a very strategic reason.
Okay, I'm intrigued.
There are optional methods, like the non-farm optional method. It allows you, even if you have a small profit or even a loss, to choose to report a certain amount of earnings for SE tax purposes based on your gross income up to certain limits. For instance, you might report 2/3 of your gross income up to a point, or a flat amount like $7,493 if your gross income is higher.
So you're essentially deeming yourself to have earned more for SE tax purposes than you actually did profit-wise. What's the payoff? Why do it?
Okay, here's the aha for your long-term security. The main reason is to earn Social Security coverage credits. You need a certain number of these credits over your working life to qualify for retirement benefits, disability benefits if needed, and survivor benefits for your family.
So if you had a low profit year or a loss, using an optional method ensures you still get credits towards Social Security.
Precisely. It keeps you on track for those vital benefits. It's a forward-thinking strategy. And there's another potential benefit. By increasing your earned income for tax purposes, using an optional method might actually make you eligible for or increase the amount you receive from certain tax credits. Think the Earned Income Tax Credit, EITC, or potentially the Child Tax Credit.
Wow. So paying a bit more SE tax now could actually result in getting more money back from tax credits today, plus securing future Social Security.
It's possible, yes. It requires careful calculation, but it can be a really smart strategic move, turning a seemingly negative, paying more SE tax into both short-term and long-term financial benefits.
That is genuinely fascinating. It's not just about minimizing tax this year, but maximizing overall benefit.
Exactly. It's a broader view of financial well-being. And remember, if you and your spouse both have self-employment income, you each file your own schedule, SC. Outro.
Wow. Okay. That was definitely a deep dive. We covered a lot of ground on navigating taxes for small businesses and the self-employed.
We did. And hopefully understanding these forms, these deductions, exclusions, credits, it really shows how being informed can genuinely impact your bottom line. It's about being proactive.
Turning tax time from something you dread into, maybe, an opportunity to fine-tune your finances.
That's the goal. And remember, the absolute best tax-saving strategy, it often starts way before tax season.
Meticulous record keeping all year long, right?
Absolutely. Keeping good records is the foundation for claiming every single deduction and credit you're entitled to.
So maybe here's a final thought for everyone listening to kind of chew on. What's one seemingly small, everyday business activity you do that if you started documenting it properly today could potentially unlock a surprisingly significant tax saving for you next year?
Great question. And if you hit roadblocks or need more info, irs.gov is always there with forms and tools. And don't forget the Taxpayer Advocate Service. They're an independent part of the IRS that can help if you're having trouble resolving tax issues through normal channels.
Excellent resources. Well, until our next deep dive, keep looking for those insights that save you time, save you money, and hopefully a little bit of stress.